Hey guys, got an exciting one for you here today. Warner Brothers, ticker symbol WBD. I have put a ton of time here, upwards of 20 hours into this one company, trying to understand their fundamentals, their leadership. So stick around guys, because we're going to be talking about if they offer value to really grow your investments long term. We're going to be talking about the issues that brought them to the position they are now, and addressing those concerns if they are or are not big and meaningful going forward, or if they can be overcome. So with that, guys, we're going to jump right into it. Warner Brothers is a massive company with tons of different things that they own, different brands. You can see that they have Game of Thrones here, they have DC, they have Discovery Channel, they have the Food Network, they have HGTV, CNN, tons of others. Some of their most recent releases have been Wonka and Dune, probably movies that you're familiar with, but those are just some of what Warner Brothers has to offer, a company that was founded in 1923 and IPO'd in 2005. Looking at their stock chart, just to give you an idea, again, IPO'd in 2005, had a nice run up to 2013, but since then has really had a downward trajectory, bringing it to where it's at today, sitting in the mid $8 range. They had this big spike here in 2021, which we're going to talk about, was a merger between Warner Brothers and Discovery, giving us the current name, Warner Bros. Discovery. And we're going to be talking a little bit about that. It's an important context to understand how this company got in the situation they're in today. One of the biggest issues that Warner Brothers has is their debt. And to understand how they actually got in this situation happens to be a part of the merger that they had with Discovery. On April 8th, 2022, Discovery, a global media company that provides content, completed its merger with Warner Brothers business of AT&T and changed its name from Discovery Inc. to Warner Bros. Discovery. And they took on $13 billion in debt from Discovery and another $43 billion in new debt owed to AT&T, who previously owned Discovery, bringing their total debt to $56 billion for this company at inception as they combined and kind of merged everything together. This is a pretty large debt load for a company with free cash flow in 2022 of $3.3 billion. When they merged, you can see that 56 million compared to 3.3 billion in free cash flow that same year. And since this time, since their merge, they have paid off 14 billion in debt, but it's still a concern and they need to continue to pay off that debt, and it could be a serious hindrance for being able to have the cash they need to have growth here. You can see this is their current obligations that they have. Their principal payments in total between the short term and long term total about $44 billion now. And they still have interest payments that they expect of about $33 billion. In the short term, that's very minimal, around $1.8 billion of principal payments and $2 billion of interest payments, which is very large. Could weigh on this company, and we're going to talk about what weight that could have and what impact it will have going forward. Another big piece for this company is a renewal of their NBA contract. Warner Brothers has a deal along with Disney, and they're both, between the two of them, spending $2.7 billion a year to have a contract with the NBA to stream their games, which is ending at the end of the 2024-2025 season in April 2025. They're currently looking for renewal, but there's a risk that they might not renew, or even if they do, the costs are so high that they could put a drag on their free cash flow. Guys, this was a pretty difficult issue to address. I am not going to lie. I spent hours and hours trying to get into the details, and I'm going to give you guys everything I have because I think this is important, but you guys will see a little bit on that later. The third biggest issue that I saw was continue to grow their streaming service, Max. Currently, this is one of the biggest stories, in my opinion, of the entertainment industry. Disney, Warner Brothers, Peacock, Paramount, all the others you could name out there that are transitioning to a subscriber model instead of selling their shows to companies like DirecTV, like Dish, and putting those channels on those packages that those companies set up to a direct consumer model that they have going on. This transition is still really uncertain, and so growing this for them is going to be a really big story. Streaming services are still a new industry and have yet to fully prove profitability. Warner Brothers is going to rely heavily on this business in the future to replace their declining network business, which is their more traditional channels that they still push through Dish and DirecTV. It's a declining business, as you can imagine. Not necessarily steeply, but it is declining. Another important note, from March 2023 to December 2023, subscribers for their direct-to-consumer business went from 97.6 million to 97.7 million, only a gain of 100,000 subscribers, which is not really that impressive of growth. Currently, Max has a market share of about 10%. Now let's go on, and I want to actually address these issues one by one, everything that I was able to find. And guys, I can promise I missed things here. There is so much complexity when you're analyzing the fundamentals of companies. You want to just come to a place where you have reasonable certainty of your opinions. You're never going to get everything. There are millions and millions of variables. But with that, I want to dive into this and give you guys what I was able to find. First off, on their debt, I pulled this from page 62 of their most recent annual filing. Their cash provided by operating activities was 7.477 billion, and their capex, which is their purchase of property and equipment, was 1.3 billion, giving them a total of 6.161 billion in free cash flow. This is huge for this company because remember, they had paid down their debt to around 44 billion, and now they doubled or about doubled their free cash flow from the year prior, meaning that they have significantly more leverage to be able to pay that off quicker. Additionally, they also have a revolving credit agreement with the capacity to borrow up to 6 billion under that facility. They also have additional commitments, or have the ability to request additional commitments for another billion, and they can issue up to 1.5 billion in loans out to others as well. So they have some opportunities, if need be, to pay this off. But one of the biggest things I'm going to show you here is they may actually not need to take on any more debt unless something unforeseen comes up. This is the most important piece that you're going to see when it comes to their debt. This was from the presentation that they had at their latest quarterly earnings. And this breaks down the yearly debt maturity profile for anything that they have coming due at all over this whole time. Note down here at the bottom, this is 100% fixed rate debt with an average cost of 4.6%, which I think is very low considering what it could be issued at. Even the current government treasuries short term are higher percentage rates than this. So the government in the short term is paying higher than Warner Brothers is in the long term. Keep that in mind when we're looking here. In 2024, they have 1.8 billion, 2025, 3.1, so on and so forth. You guys can see everything here. They have consistent maturities all the way up until 2032, where they have a gap until 2036, and you guys can see this going forward. But keep in mind, this last year, they had 6.161 billion in free cash flow, which is going to allow them to more than pay off their debt each of these first 3 years. Now, 2027, it is lower than their free cash flow, but remember, they're going to have interest payments as well. So I think this will be more of a tight year to be able to cover it all, but they could stack up cash from these previous years to pay for that. And then it really, in my opinion, will be pretty smooth sailing if, and this is a key if, they can continue to generate free cash flow. When it comes to free cash flow, this was a key point that I wanted to make. This is a chart of not only Warner Brothers, but Paramount, Disney, and Netflix and their history of their free cash flow margin. Here in this lightest color, Warner Brothers, you can see for a long time was the highest in their free cash flow margin, pretty significantly beating out other companies here. You can see a lot of the time Disney is sitting in this 10 to 15% range, whereas Warner Brothers is sitting closer to 20, and even at their peak got around 30%. So I think when you compare where Warner Brothers sits right now, they're just barely coming off of their acquisition and really starting to get things rolling and getting back to a more normal free cash flow, and they still have a little ways to go. Now, Is this new company after the merger going to be as efficient as they were before? It could be, as they merge and are able to really consolidate expenses within the company and still have more opportunity to generate cash flow. I think it could be, but that is yet to be seen. Another important piece to keep in mind is the current CEO of Warner Brothers had his 2023 pay tied to how much free cash flow he was able to generate for the company. And I think this is key because Warren Buffett said something once to the effect of, show me the incentives and I will show you the outcome. And Warner Brothers, I think very wisely, is pushing, especially their CEO, to generate free cash flow, to de-lever the balance sheet, but also to make the business profitable along the way. And one thing that I think actually helps us really well is David, the CEO of now the combined Warner Brothers and Discovery, was head of Discovery, and he loved the high margin, non-scripted shows. So he's able to generate a higher free cash flow from all that. And I think that's going to be a big deal for this company going forward. So to summarize on the debt side, currently, I think Warner Brothers is in a good position based on their 2023 free cash flow. They are still moving back up towards their historical free cash flow margin. They still have room to run there. And even without increasing revenue, they can grow that free cash flow over the next few years. And their CEO has incentive, really good incentive, to do so. Regarding the second issue and addressing this, the renewal of the NBA contract. As I said before, guys, this was kind of a tough one to really dive in and try and get the numbers, because from everything that I could find, Warner Brothers actually doesn't break out the monetary significance of this NBA contract and how much it brings to the table, probably just because it's really hard to do so. So I'm going to show you guys something that I was able to come up with to try and value that position. And honestly, I could be very wrong here, but it's the best that I was able to do. And I have reasonable certainty that I'm at least within the ballpark. So to understand how big of a deal the NBA contract is, I wanted to do my best to separate out how much revenue this segment could generate for Warner Brothers Discovery. And I did so with a lot of very fun math, as you guys can tell, pulling out the profit per viewer per hour. And I did that by finding what was spent by advertisers during the 2022 NBA postseason, which was 87 games. The average game length was 2.416 hours. And had an average of 5.47 million viewers. And that comes out to 73 cents per viewer per hour. Now, if we apply this to a full season, with every single team playing 82 games for this total, times 1.62 million viewers per game, and the average game length of 2.3 hours, that gives you a total of around 4 billion. And for the postseason as well, pushing this all through with an average 80-game postseason, which might be a little less than average, as a postseason can be between 60 to 105 games, depending on how the series goes, brings it to about 739 million to a total of 4.71 billion. Now, Max currently pays 1.2 billion of the total 2.7 billion. So they pay 44% of the total cost. So assuming they get 44% of this benefit, this could potentially be bringing them in about 2.1 billion in revenue. Now, the new proposed contract for the NBA that I have seen, there's lots of different numbers floating around, but it could be anywhere around 75 billion. And assuming that's for 10 years, that means that Warner Brothers, for their same position, could be paying about 3.33 billion a year, which may not be worth it unless they're able to really monetize. Now, again, guys, I could be missing something really big here, but to me, this tells me that this might not be as huge of a deal as it seems. This is just the numbers I was able to come up with the work I did. And guys, I spent hours here. And I could have been missing something obvious, but it's what I got. The NBA currently, for their revenue, is lumped into their network segment. And you can see that their total revenues here totaled about 21.24 billion for 2023. So even with all the numbers above and estimated revenue, if this is in the ballpark of 50% above or below, then the revenue brought in by the NBA would be about 5 to 15% of their network segment, or 2.5 to 7.6% of their total revenue. And I think this can mean that even if they lost the NBA contract, it wouldn't be as large of a blow as it seems. Warner Brothers Discovery is highly diversified with many different revenue streams, especially in the network business. They have TNT, TBS, Turner Classic Movies, OWN, Discovery Channel, Cartoon Network, Adult Swim, True TV, and many others, not to mention there are many deals with other sports, including the NHL, NBL, and others across Europe as well. I would take the NBA contract, in my opinion, as not as big of a deal as maybe it's made out to be. Would it be a blow? Yes. Would it be devastating? Personally, from the work that I did, no. As I know, there have been different articles and things that I saw where Warner Brothers themselves said they don't need the NBA. They don't need them. They could live without them. And if they do lose them, it's not a company killer. In fact, it might be an opportunity to buy them at a much lower price. Now, the last issue of growing Max. This was a fun one to tackle as well, and I'll show you guys what I found. So here are some notes that I thought were important regarding Max and their direct-to-consumer business. Here's some quotes that they have from their most recent quarterly earnings. They said, "We fought hard to get Max profitable last year and are committed to driving profitable top-line growth." They also mentioned, I thought this was really important, their rollout of Max in key international regions and markets, starting with Latin America next week, with markets in EMEA and APAC to follow later this year, including new markets like France, Belgium. And keep in mind that we are only available in less than half of the addressable households and markets as compared to our larger peers. I thought this was really interesting. When you think about all the countries that Netflix, for an example, is rolled out into, Warner Brothers has only rolled out into half of those, and they're planning on having that rollout happen, I believe, in 2024, and if they have any, early 2025. So they could potentially have a lot more opportunities to capture revenue without having significant costs. They also said in Q4, they saw their lowest US churn rate in HBO Max and Max's history. And they said that they were excited to be refreshing and reigniting our content pipeline at Max. The fact is, the strikes really slowed down production, and we didn't have as much content as we wanted for Max. And we're now going to move forward with a great slate. I think this does bode well. They talk very highly of Max, but as we looked at the very beginning, they only gained 100,000 subscribers from March 2023 to December. This could be a little bit concerning for them. They're not seeing some of the growth that I think others, like, for example, Hulu is growing very well, that they're seeing. But they also have some other things here that I think could be really important. I think it is pretty clear that Max does have potential, although it's not going to be an easy road with some serious intense competition like Netflix and Disney. They do have some great leadership that I think is going to be a major deciding factor for their business. And one of those is going to be Patrizio. I'm not even going to attempt to pronounce his last name because I will butcher it. But Patrizio is their current chief marketing officer with a focus over their direct-to-consumer business, and was the VP of subscriber growth at Hulu from 2016 to 2021, during the time of which subscribers for Hulu increased 242% from 12 million to 41 million. I think, from what I see, this guy has serious experience growing specifically a direct-to-consumer streaming business. And David Zaslav, the CEO, is a guy who, in all my readings, who is all business and particularly likes more emphasis on high margin media entertainment than most other media companies. Everything that I was able to find on this guy and I read was he is all business. He wants things done and gets them there. He is a guy who I think knows how to make money in the entertainment industry, which is obviously very important. Someone at the helm who's really going to be able to guide them into profitability, with also someone like Patrizio that I mentioned before, who has experience growing subscribers. So I think that that leadership could put them in a good position to grow Max and do it profitably. All right, guys. So to review everything and kind of my thoughts on what we've gone over today. First off, I wanted to say the streaming industry is rapidly changing. That in 10 years from now could look very different than it does today. They're still highly uncertain who is going to survive, although I do think Warner Brothers Discovery is positioned well. They do know how to generate free cash flow. And I think they'll be able to generate the free cash flow if they're able to execute well on their direct-to-consumer business. Regarding the NBA and that contract, I don't think that's a huge story for the company. I think that if they keep it or they lose it, I don't think it's going to move the needle massively one way or another. I think Warner Brothers still has massive opportunity for growth, not only releasing Max in more international areas and moving it out to more addressable markets, but also just bringing their cash flow margin back up to where it was before the merger. And I think that they should be able to do that with a manager and CEO like David, who is ruthless in generating efficiency and cash, just running a business very well. I think that they could bring that not only to where they were before, but steadily above where they were at. And hopefully Patrizio lives up to everything that I saw him do at Hulu as well, and is able to grow subscribers, and they're able to really grow their market share. I think they have a good and compelling library of content. If they can continue to potentially make little acquisitions here and there, or just really continue to release good content like Wonka, like Dune, that have done very well in the box office, I think that they have a great value proposition for potential subscribers. I think overall as well, the industry as a whole could see about 5 to 10% growth in the media entertainment space over the next decade or so. This is me not necessarily looking directly at the direct consumer streaming, but more just the media entertainment in general. A little bit more conservative than I think most would say about the streaming platforms and services, but I wanted to take a little bit more conservative view to actually give you guys this next piece, which is looking at valuations and what is this company actually worth. All right, guys, looking at valuations through a discounted free cash flow model, which is what I really like to do. I'm not worried about getting things down to the penny correct, but I want to give kind of a range to see, hey, is it obvious that this company is undervalued? So first, we're going to look at 5-year projection into the future, and I'm going to assume a 0% growth rate, 0% growth in their shares outstanding. If you see this number here, their shares outstanding over the past 5 years has grown about 28%, but that's because they issued a ton of shares with the merger and bringing the two companies together. So it was kind of a one-time thing. And I think an appropriate price to free cash flow is around 15. So just assuming this, what is the current fair value to get a 10% return over the next 5 years? If you were to buy the stock and get that 10% return, that fair value would look at around $23.52, which is 178% above where we sit right now. Now, the next that I'm going to assume is a 3% growth rate every year on their free cash flow. That puts us at a fair value of 222% above where we sit right now, $27 a share. Assuming a price free cash flow growth rate of 7%, that puts a fair value at around $33 per share. And assuming an 11% growth rate, which I think is certainly not out of the realm of possibility for this company, they're going to be optimizing very well, I think, over the next coming years. I don't think this is what I would like to assume for myself to give an idea of what their value is, but I wanted to show because I think this is very much in the realm of possibility for the company going forward. So an 11% growth rate would mean the fair value of these shares sits at around $40, 370% above where they sit now. I personally can come to a reasonable conclusion that Warner Brothers Discovery is undervalued, and undervalued significantly when you compare it to and address the current issues that have actually driven it down to the price where they're at now. I think they're very addressable, and in fact, honestly, already overcome, as long as there are not big unforeseen events or that the management is completely unable to operate and succeed on these different things that I think they have in front of them, generating free cash flow and growing the subscriber base on Max. Those are two important keys. So to reiterate and give my final thoughts here, Warner Bros. Discovery is undervalued. However, I don't think it offers enough value at its current price on a risk to reward basis for me to merit adding it to my portfolio. I currently have a watch price on the stock of around $7, and at that point, I would initiate a starter position, ready to add more if it goes lower. I have many other opportunities that I'm currently invested in, and I think they offer a better risk to reward ratio when I look at the current upside potential of Warner Brothers over the long term. So with that, guys, do your own work here. This was all my opinion, but I really hope it was valuable, and I appreciate you guys being here. We'll see you in the next one.